After 2 weeks of downward movement in equities, are we in a downtrend? As you can see from this chart, the past 2 weeks have both ended down from the previous week. In my video last week, I said, if I were going to base a prediction just on this chart, I'd say we're going lower next week. Now, the hesitancy I have is this is the last few days of the year when tax loss selling comes into play. So the question is, next week, will investors continue to sell, or will people jump in and say, hey, this is an opportunity. Equities have pulled back. I'm going to jump in and buy now. I really wouldn't want to make a prediction based on this last 3 days of the year. So I'm not going to. Let's see how next week plays out. But based on these indicators alone, if I were going to make a prediction, I'd say we're going lower next week. But who knows? And as you can see, I shouldn't have hedged my call based on it being the end of the year. All of the indices closed lower for the week. But the reasons I hedged my market direction call were as follows. 1, it was the last 2 trading days of the year when tax loss selling can really be a factor. And 2, the very influential jobs report was going to be published. It came out just this past Friday. All that being said, let's take a look at the metrics and how the equity, bond, gold, and crypto markets look right now. So if we look back over the past week, you can see we've had a very unhealthy risk appetite, with ARK Invest down the most, small cap second, NASDAQ third, S&P fourth, and the Dow doing the best, the safest equities performing the best. This is not very good looking. And what if we look back over the past month? Well, as I mentioned earlier, you can see that a couple of weeks ago, the markets just really started to take a dive and fell. So while this is up for the month, it's looking pretty unhealthy right now. And if we look year to date, well, we had a very, very healthy return for last year across the board, but now you can see that things are really starting to collapse here. I'm afraid to say how I... And what about those bottom dynamics? Well, last week, as I mentioned, you can see that the bottom confirmation signal was dropping here, and the confidence was rising, which told me that the markets were likely to continue lower. And you can see that's exactly what happened here. Well, where are we now? Well, where we are now is the confidence level is continuing to rise. And in fact, it's at a very high level here in the mid to high 90% range. But you can see that the bottom forming indicator is shooting higher. Now, we don't have a bottom forming indication here yet. This would need to get up here near or at 100%. We're not there yet. But if I look at this, it tells me that we're likely to go lower next week. And what if we look at risk versus opportunity? Well, there's some alarm bells going off here a little bit, but you can see what's happened with risk acceleration, this yellow-orange line. It's been rising lately, although it trailed off a little bit on Friday. You can see that risk, which is very much a lagging indicator, is still heading lower. I'm not surprised by that. But you can also see that the opportunity level, which was up here at a very healthy 75, has been falling, and it's now below 70. And worse yet, it's pointing lower. So don't like what I see here. Not ready to set off the alarms yet, but I don't like what I see here. Don't wanna let you down. And what if we look at equity versus safety? Well, equity versus safety last week really couldn't have looked much better, as you'll remember from my previous video. But if we look at where we are now, you can see that the NASDAQ 100, fell down here. It came back very, very nicely, and it just tanked this last week. So this is a risk-off move if I've ever seen one. What about small caps? Well, small caps appear to be holding up reasonably well, though they're still ranked number 1 in this chart. And what if we look at cash? Well, I don't like what cash is doing for 2 reasons. One is cash has moved up from 9th place to 8th place, while the NASDAQ 100 has moved down. But what displaced cash? Well, what displaced cash was intermediate treasuries. So treasuries are also starting to show a flight to safety, a move away from longer duration treasuries into shorter duration. Now SHV is still at the bottom though, but you'll see some of this when we look at some of the other metrics around treasuries. And the other cause for concern here is look at what the Dow Jones Industrial Average has done. The Dow Jones Industrial Average has moved from 6th place all the way up to 3rd. Now the Dow contains safer equities. They're larger, more stable companies. So this shows me there's still a risk appetite, but there's a fear of what are considered higher risk assets. People are dumping the NASDAQ 100 in favor of the Dow Jones Industrial Average. I don't think this is going to play out well over the long term, though. This is usually a foolish move to try and do this kind of thing. And what if we look at treasuries? Well, treasuries still look really good. I mean, you have the longest duration treasuries up here at number 2, even though that they've been kind of pulling back lately. And TLT has fallen back to 4th place. So clearly treasuries, as you'll see later, have been falling recently. I don't know how long that'll continue and if and when it'll turn around, but I think there's good reason to believe that over the long term, yields will come down, which will drive the prices of these much higher. And you can see what I talked about with cash being displaced by intermediate treasuries. And again, this will show up when we look at the buying and selling pressure for treasuries. Well, before we look at the buying and selling pressure for treasuries, let's take a look at the buying and selling pressure for equities. And you can see here what's been happening. As I mentioned, the Dow has been doing relatively better than some of the other indices. And you can see that in the price action here. The Dow is kind of flat topped while the others have all been kind of dropping back. And you can see it in the buying pressure, this solid gray line, which is not only above the selling pressure, but moving higher toward the last part of this last week. Well, let's compare that to the S&P 500. You might hear my cat in the background. Let's compare that to the S&P 500, where the selling pressure has been shooting up and is much higher than the buying pressure. Same picture with the NASDAQ 100 and a similar picture with ARK Invest. And you can see how the prices have been declining here. And if we take a look at small caps, very same picture. Look at this, prices falling, selling pressure well above the buying pressure. Although in all of these cases, it looks like on Thursday and or Friday, the selling pressure really started to decline. So hopefully this is a good sign going forward. And how does this look when we take a look at sector rankings? Well, if we take a look at sector rankings, you can see last week we had a very healthy looking risk appetite with Bitcoin and ARK Innovation right up here at number 1 and number 2, semiconductors, technology, the NASDAQ 100. And you can see the consumer discretionary well above consumer staples with cash down at the bottom. Well, not much has changed this week. And you have to remember these move very slowly, although you can see that the NASDAQ 100 has moved from here down 1 notch to here. These again move very slowly. So you have to look over several weeks to really get a sense of where this is headed. But let's take a look at sector rank acceleration because these move more quickly. They tend to give you a better sense of where the market is moving toward. So let's take a look. Well, last week we had ARK Innovation down here, semiconductors here, small caps here, and the Dow here, and consumer discretionary, consumer staples here. Well, and cash down here. Well, where are we this week? Well, you can see cash has really made a move much higher here. Consumer staples have moved up, which is what we saw in the Dow. Interestingly enough, though, the Dow in this look has gone from here down to here. And you can see that when we go from last week to this week, SOX, the semiconductor sector, has moved down a couple of notches here. Emerging companies, IWM, small caps, have moved up, actually, interesting. And the NASDAQ 100 has gone from here, down here, all the way down to here. So we're starting to show a little bit of risk aversion here in these metrics. Now, what if we take a look at treasuries? Well, as I mentioned, treasuries have been in a downward trend over the last week at minimum. And you can see that here. This is an unhealthy appetite for long duration treasuries. And if we take a look over the last month, you can see there was a very nice rally here, but we've been pulling back actually over the past 2 weeks, just like we have with equities. And if we look back over 1 year, you can see how treasuries, long duration treasuries, just absolutely got trashed. Now they've been making a very strong comeback up until the last couple of weeks when there's been a pullback here. And some of that might be caused by the Fed making hawkish comments about rates staying higher for longer. Now I want to show you this. Actually, let's back up. Let's back up one. I want to show you this because over the past year, longest duration treasuries are down about 12.5%. Well, for them to get back up here to even, to zero, where they were a year ago, that would take about a 14% increase in price level from here back to the zero line. So that's a pretty good return if that happens. Now, in the next picture I'm going to show, we're going to look back over 5 years. And if you look back over 5 years, these are down, the longest duration treasuries are down almost 31%. So how much would they have to go up to get from here back up to where they were 5 years ago, back in, call it 2019? Well, they'd have to go up over 40%. That's one heck of a return. And I think over the long term, these will eventually get back to where they were back in 2019. And you're going to have some very happy bond investors if that happens. And as I mentioned earlier, let's take a look at the buying and selling pressure for treasuries. Well, you can see that there's been a very big rush into short duration treasuries, although the price has been declining just like it has even for the longer ones. But you can see that the buying pressure is still well above the selling pressure and in fact is heading higher here. Now that's in real contrast to the rest of these. Intermediate treasuries, a more severe price decline, and you can see the selling pressure. This orange line is not only above the buying pressure, but it's moving higher. The same is true with what I call intermediate to long treasuries, 7 to 10 years. Price decline more substantial, selling pressure above the buying pressure, moving higher. 20-year bonds, long bonds, they were kind of flat here. They've been pulling back. And again, the selling pressure above the buying pressure and moving higher. And what about the inverted yield curve? Well, if we take a look, it's gotten a little better. It was inverted by almost 50 basis points not too long ago. Now it's at 34 basis points inverted. And you can see what the markets think. When the Fed meets on January 31st, there's a 93.8% probability that the Fed will leave rates exactly where they are. But if we go out to March, you can see that probability drops to 32%, and there's a higher likelihood that the Fed will actually lower rates by 0.25%. If we go out into May, you can see now, not only is there a likelihood the Fed will lower rates by 0.25%, but the markets are tilting more toward a 0.5% rate decrease by then. We go out to June, and it gets even better. You can see that the blue line, the current interest rate, is almost at 0% likelihood. And then by July, that's gone, and you can see that rates are expected to be quite a bit lower from where they are right now. I feel like I'm afraid. Yeah, what about gold? Well, yep, that's kind of been going nowhere, and I don't see any reason it's going to go anywhere in the near term. You can see that we had a big rally here, pull back, tried to rally again, and now it's been floundering again. And you can see that the selling pressure is above the buying pressure, although it's dropping and the buying pressure seems to be coming up a bit here. I'm not a fan of gold, so I'm not going to try and call this one way or the other. And what about Bitcoin? Well, interestingly, Bitcoin has been really kind of treading water here. Slight uptrend, but treading water. We have an SEC decision coming up this week. And as Cathie Wood says in her In the Know video this week.
But today we have a very special guest. He is our Director of Digital Assets, Yassine Elmandjra. This is a very important time we think, in the history of a new asset class. And so I wanted to bring Yassine on into the In the Know so that you are in the know if you are a bit curious about Bitcoin.
Obviously a wild year. We think about the last 10 years where Bitcoin goes from, this weird magic internet money to, this weird asset that's for drug lords and criminals and terrorists to a speculative asset for, hobbyists to now a very strategic addition to a diversified investment portfolio. I think you see Bitcoin's resilience in 2022 after the massive contagion that we saw. Not only was Bitcoin operating, but it was thriving. And in 2023, I think people started to realize that, and that was reflected in price. Coming into 2024, especially with this, Bitcoin spot ETF approval.
How many assets are there like that out there? So big aha moment last year.
I really think that that moment will go down as the event that really marked the perception shift from Bitcoin to being risk on to both risk on and risk off. And now,
can I just say something about that to help people understand? First of all, what were we saying about FTX and all of the bad news last year? We basically said, this is proving the point, the reason Bitcoin is important. FTX was completely centralized, completely opaque, and it turns out completely fraudulent, right? And what do we have in Bitcoin? It is completely decentralized, completely transparent by digital wallet address, and basically a giant neighborhood watch system, because there are so many people watching now, people whose livelihoods depend on this, not just in the developed world, but especially in the emerging markets. So it helped us prove the point. And then on deflation, what was that point? Well, there is no counterparty risk with this transparent, decentralized ecosystem. Unlike our banking system circa 0809, counterparty risk was the reason the financial markets seized up and were paralyzed, and why the financial authorities and fiscal authorities had to come to the rescue. That will not happen with Bitcoin.
That's absolutely right. I think it's worth unpacking that a little bit further, because you basically outlined one of the several characteristics that we've defined as what makes an asset actually risk off, right? To your point, you want an asset that provides this safety or this capital preservation. Bitcoin does exactly that, given it's a decentralized network. It's independent of any single entity. And I think you hit the nail on the head. That makes it a natural protection against counterparty risk and arbitrary asset seizure. Then you look at things like diversification, right? You want a risk-off asset that is, uncorrelated to traditional asset classes. You look at the last 5-year rolling correlation of Bitcoin relative to traditional asset classes, and you find that it performs relative to other asset classes. It's the most uncorrelated, or presents the lowest correlation against traditional asset classes. And so now, when you're an institutional allocator looking just to diversify your portfolio, Bitcoin, including that, is definitely a risk-off narrative that has matured. Then you think about things like having a long-term investment horizon. People tend to look at Bitcoin's short-term swings, but over the long term, it's been able to preserve capital as this compelling store of value, unlike any other asset class.
Unlike any other asset class.
I think you have the Bitcoin spot ETF approval, you have institutional acceptance. You obviously have the Bitcoin halving, and maybe we can end on that note. This Bitcoin halving, which is a scheduled event that occurs approximately every 4 years, is expected to occur in April of this year. And I think it's quite a provocative event in that it reinforces Bitcoin's scarcity, and that it is effectively the most predictable monetary system relative to its monetary policy the world has ever seen.
So just to get to help explain that a little bit, the halving means the rate of growth in supply is going to be cut in half. Is it to 0.4 or 0.5%?
So reduced from about 1.8% to 0.9%. So just
Okay.
under 1% inflation
Per
now.
year,
That's right.
which means if you compare this to gold supply has increased on average roughly 1% per year.
And then maybe to wrap it up, I think what's a really interesting dynamic that we haven't seen in previous market cycles is the buyer and seller behavior broadly is much more long-term focused than it's ever been. This chart, it shows the chart of total long-term holder supply overlaid by Bitcoin's price, which now stands at around 15 million or 76% of Bitcoin's circulating supply. So in other words, we're basically saying that 76% of Bitcoin supply are held by long-term holders. This suggests that that 76% is locked in a way that you're not going to see a marginal demand be absorbed by the supply. The supply is relatively finite relative to what we've seen in previous market cycles. It's interesting to note here as well that in market tops, or in really bull markets, we see a decline in that long-term holder supply, largely because long-term holders are taking profits. Here we have yet to see that decline, which again denotes that, despite being up, several 100% in a year to date or in 2023, that we're still likely not in sort of the euphoria territory, and that this might actually be just the beginnings of a bull market if we were to look at long-term holder supply as a proxy for risk on versus risk off narrative.
The thing that strikes me about this is just to, you said it, 75% of the outstanding supply of Bitcoin is in the hands of long-term holders. And I think what that means is this, they've held it, have not moved it in about a year.
That's
or
right. It's about a little over 6 months. The year supply, that's about 56% of total supply has not been moved in over a year. But we used heuristics where that 6 month threshold tends to be the long-term versus short-term demarcation.
So there, I'm just looking at the number here, about 15 million of the Bitcoin supply out of 19.5 million outstanding is in the hands of strong holders. And we know that the total supply ever is going only to 21 million. So to pry it out of the hands of these long-term holders, now that institutions are going to be given, we believe, the green light by the SEC, we hope and believe the next week, the price that they're going to demand, now that this asset is so scarce, and the push in from institutions, it won't happen all at once right away. There are lots of boxes to check and so forth. But I think the long-term holders understand there's a big buyer on the way here.
Absolutely. I think 2024 is certainly an exciting year, and January is an exciting month, just because of all of the talks around a Bitcoin spot ETF approval.
It's really not clear to me if this current downtrend will continue lower or not. It's really too early to tell. So I'll just have to stay vigilant and keep reporting on the metrics and how they change over the next several weeks. Look, if you're going to be a long-term investor, and I highly recommend this approach, then allocate your portfolios according to your risk tolerance and stop rebalancing, or worse yet, selling after big gains. And hold on for the long term, especially if you're managing a taxable account where selling will cost you big time. I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and the other video is titled The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns round. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here written in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips but the sun is drowning. Pour it out if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold but it's lonely, yeah. This life feels like the sunny water.